Hey, welcome back, everybody, to the four-star podcast series, Today's Market Explained. This is your host, Brian Castle, and I'm here with Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Happy to be on and happy to talk a little bit about the markets.
And here we are again, and we're approaching 200 episodes. So when we hit our 200th episode, we're going to have a big party, and we tell everybody about it. Today we're going to do our standard routine. We're going to talk about the markets, what's going on out there, what are the trends. Then we're going to talk a little bit about the economy, and we're going to talk about special things that we see out there that everybody should know about. So there we go, Chris. Why don't we start out for the day? What's going on in the markets relative to all the different asset classes that we can invest in?
Yep. So no surprise here. Domestic equities is still leading the way. It's in the number one position. It actually gained 8 points from the last podcast, so it's at 317 tally points now. So it continues to gain strength in that number one position, really edging up into the 300s there. And in the number two position, we have international equities. It gained 5 points, so it's still moving upwards, maybe not quite as quickly as domestic equities, but still strengthening. It's at 257 tally points. So we still are seeing a clear gap between the number one and number two positions, but they are by far they separated themselves from the rest of the pack. Because commodities is in third position. It's equal since the last podcast, and it's at 196, so it's out of the 200s.
Mm-hmm.
Cash is in fourth at 140, -7 tally points. Currencies is in fifth, -4 at 94 tally points, and fixed income is still in last place or sixth at -1 tally points at 84. So really the bottom three asset classes, I would say for the most part are non-factors, with two of the fifth and sixth positions, currencies and fixed income, being under even 100 points there. And cash is really starting to move down. A lot of the gains for domestic equities and international equities have been taking away from the cash positioning from a relative standpoint. So we'll kind of see, but overall, that's overall points to a strong market from a asset class perspective. When we have domestic equities and international equities as the one and two asset class, it usually means a strong growth market for the world.
Yeah, those are the three risk on categories, Chris, right? And the others are sometimes what we call the scaredy cat categories: cash, currencies, and fixed income. So it's a risk on market, isn't it?
Yep. Yeah, exactly. And yeah, I mean, the one up there, commodities, I mean, it is a risk on category, but the issue with commodities is, as you've talked about, I believe on this podcast a couple of times, Brian, is, that tends to be a drag on the global markets, because when commodity prices are high, that means higher input prices. So, usually when you have domestic international really moving, it points to a quicker moving market. It's usually a better indicator than commodities being up there, because eventually the drag there will cause usually domestic or international to pull back slightly.
Mm-hmm. Then now, Chris, we're getting to a record level on domestic equities. I don't remember the exact number, but out of the potential tally scores of all the different indexes that are tracked against each other, there's a finite number of about 1,080 different tally scores. So any one of the six to have well over 300 is quite a significant number. So we're at 317. I think the record is just north of here. So we're clearly in a U.S. directed market.
Yeah. I think the highest we've seen it in last 10 years really is in the 320s, and maybe 324 around there ballpark. So it gives you at least some indication as far as relative to other bull markets we've seen in the past 10 years. That this is showing some strength for sure.
Yeah. So now, well, thanks, Chris. Thanks for that update. Now the markets are breaking to new highs. And so you say, well, what do you mean a new high? Well, market high previous to this time was in 2021. So then 2022 was a terrible year. I always like to say it's the worst investing year of my now 40-year career. And a lot of people got hurt last year. The bond market was down big in 2022. And then, of course, the stock market was down 20, 30. And if you were in tech stocks, down over 40%. So if the market's now breaking the new highs, that means 23, the market's recovered. And now we're going to new highs from 2021. So now we're into 2024. It's been a little while since we've hit new highs, right? So what's happening now is, on the part of a lot of investors, they're looking at their account statements and they're thinking, gee, I should have done a lot better. markets at new highs now. What's going on? But if you look at what happened in 2023, the markets were higher, but only up about the average stock was only up about 11%. When you consider all the names that are out there, all the performance of all the names. So, but if you look at the indexes, because of the market cap weighting and certain names, we talked a number of times on the show about the Magnificent Seven and technology names, that those so far distorted the indexes. So the average stock and the equal weighted index of the Standard & Poor's is up 11%, but yet the index itself was up 24%. It's one of the widest disparities in a major index between the equal weighted index and the market cap weighted index. Market cap weighted index is what they quote on TV all the time. S&P is up, S&P is up, whatever. But the average stock is really what investors buy. Usually they're not that far apart. But last year they were way far apart. So a reasonable expectation in the year when the average stock is up 11%, let's say you have 50 to 70% of your money in stocks, and then you have 30 to 50% of your money in other things like cash or bonds or something. So, and then that market was down again last year in 23. So an expectation might be 6 or 7%, right? Would be a blended mixture of that. So that was a decent return. But if people got 6 or 7 and then they hear the S&P up 24, they're like, what's going on here? I'm not doing well. But I think it's silly season because people are going to make decisions with that kind of math and say, I need to switch or fire my advisor or buy a new fund or do something different. And we're going to chase performance, which is what a lot of investors do. So I would caution everybody from doing that. If you look this year, so year to date, markets are strong, but it's not just the Magnificent Seven anymore. There's a lot of other things coming alongside, Chris, right? With small caps run, right?
Yep. Yeah, we're certainly seeing it's the breadth of the market has been a lot better, a lot than just the Magnificent Seven this year. I think a lot of that points to earnings. I think we've talked about it before. Earnings have been strong this year for the most part. Not everyone has beat, but a lot of companies have beat. So I think that has helped propel more of a broader market rally to start this year so far. And one of the things I would highlight with the Magnificent Seven, just kind of talking about them, is there's been rumors now like should Tesla be removed from the Magnificent Seven, and just in the last 2 days, I want to say it's been down 10%, if not more, Tesla alone. So with that high upside you're getting in that S&P 500, which is more of a momentum, I would say more of a momentum index. So you're getting a lot more exposure to these high momentum stocks, just because it's not equal weighted. It's so, when those are picking up speed, they're just gaining more market share within that index and kind of taking more control of it. So a lot of people love that upside, but they don't love the downside. So, I would say, if you having that conversation and thinking about it in that perspective of, being up 11% and being maybe down a more moderate 11, 12% might be a better from a risk appetite perspective, or a blended 6% and only being down 3 or 4%, rather than maybe capturing that 25 to 30% upside, but you're also going to capture that 50 to 60% downside because those stocks are volatile and you will capture that.
Yes. Well, and just for the record, in 2022, Tesla was down over 75% at one point. It had a rally. It closed only down 65%. So what goes up does come down. And now then there was a big rally in 23, but a lot of those folks are still breaking even. If you're down 50%, you have to go up 100% from the bottom. That can take a decade in regular stocks. And it's hard for stocks to do that. So you want to avoid those big downturns. So yeah, so just perspective again, Chris. I mean, looking at how the markets have performed in 22 and 23, and it's been since 21 since we had any kind of rallies. And of course, we had a market collapse in 2020. A lot of people panicked and got out, and then the market rallied to close up nicely in 2020. But a lot of investors got hurt in 20. So they got hurt in 20 because they didn't manage it right. 21 was a little bit of a rally. 22 was terrible. 23 was good, but people thought they did worse than they should have, and they probably were okay. So a lot of investors are pretty upset about what's going on in the last few years, and they're thinking, oh, I got to do something different. I would caution everybody from doing that, because this quarter is a good example so far of how the markets are now broadening. And there is $6 trillion in cash out there, Chris, as well, that is not invested in anything, just sitting in money markets. And eventually that money is going to come out. If rates do start to go down, that money market's not going to pay 5% anymore. They pay 3 or 4. And then you're going to want to say, hey, maybe I'll buy a stock and not just take 3%. So, so watch for that. There's tons of wind under the wings of the markets, very possibly this year, if that scenario plays out the way it does.
Yeah, yeah, certainly. I mean, I think there's a lot of cash that's on the sideline. I think the Fed knows that. I have heard, you know, strategies the Fed's throwing out to try to get that money actually back in the market without having to raise the rates, so still keep the market, the general market tight. So you know, we'll see. I think we're in a very, very unique environment right now, as you alluded to, Ryan. I mean, I don't think anyone would have predicted. I mean, those last 3 years, we're talking about COVID pandemics where you've seen world shut down, supply chain collapses and crunches. I mean, you've seen we've almost gone through like 4 or 5 mini cycles and crashes and unique experiences on those last 3 years. And then now we're entering what some people have said, you know, party like it's 1999. We're entering almost like an AI fueled craze. So it's a
Mm-hmm.
pretty unique timing in the market, I would say. And I think it's a very good time to make sure you are being, you know, staying in control, because it's really easy emotionally, you know, for investors to have FOMO, investors to, you know, say, oh, well, I should just be in the S&P. You know, the issues that come with that, yeah, you might get a little bit upside, but eventually we're going to have a down year. And with the volatile markets they've been, you know, the likelihood is it might be sooner rather than later. We hope not, but
Right.
markets are volatile right now.
Well, and you know, if we keep watching CNBC and different financial shows, they say, well, the index is up, and that's kind of seen as the standard. And since they talk about it all the time, we just convince ourselves that we should be in the index. Well, that's fine, I guess. And over time, the indexes have done well. S&P has averaged about 10% return. But if you did just invest in the index and you have big returns in good years, there are periods of time when the index is down big. In the 1970s, the S&P 500 was down 78% from top to bottom. So in the 2008, 2009 period, from the top in 2007 to the bottom in March of 2009, the market was down about 58%. So if the index is the standard and we're okay with the index, are we okay being down 58%? Are we okay with being down 78%? I don't think so. So maybe the index isn't the only thing we should consider. And if we're measuring ourselves against an index, and you know, you should, in theory, be okay being down 52 when the market's down 58, right? You beat the index, but you're not going to be okay with down 52. You're not. So
So
maybe we should take other measurements that are a little bit more thoughtful about how investors should invest their money. At Four Star, we attempt to get every bit of the upside and then minimize the downside by raising cash. And we've been able to do that in the bad years like 22. Most of our portfolios that were taking risk were down at less than half, in some cases only a third of what the benchmarks were down. And then the bond market is a totally different wild card. It was terrible in 22, but fine in 20. So, you need to think differently about the index. Just a knee jerk, hey, I'm going to measure myself against the index, really is terribly not terribly thoughtful long term. Maybe it's good in an up year, but not as a long term goal. So, so
yep,
there we are.
yeah,
So
would
Chris,
agree.
about the markets, you know, a couple other things. You know, Apple was trying to make an Apple car, and that's gone. And then you were talking about how you know, Apple is now doing difficult in China. We'll come back to that. Chinese cars are being watched now for surveillance. So any cars that are produced in China and other countries, they're seen as surveillance vehicles because China's trying to take over the world, and they're using that to get information on all the countries that they're in. So be careful of that. General Electric, everyone knows as the best consolidated company in the 80s. Jack Welch, the chairman. It was a great time, the best compounded returns of any conglomerate for decade and decade. Then it got too big and they had to disintermediate it. Jeff Immelt took over as CEO. They had a very bad decade. Now a new CEO's come in and they're trying to split everything up. And many of the companies have been spun off. The final split is GE Aerospace, GE Verona, and GE Healthcare. Aerospace is obvious. That's the main company. Verona is all the wind related machines. And then healthcare, of course, is healthcare. So healthcare is now trading at 21 times. The group is trading higher than that. So maybe there's an opportunity. That's all the imaging and all the healthcare imaging. So, there's times to consolidate and there's times to disintermediate. Right now in GE, that's the disintermediation campaign, and that's what they're doing. They'll get more value out of all of that separating it than they will together. And so that's an interesting trend. Also, 3M, the big conglomerate out of Minnesota, is splitting up, and they have huge liabilities on the main company, but they're trying to split off the healthcare because they're not getting much multiple on the healthcare because it's tied to all the other business things where they're struggling a little bit more. So it's always interesting to watch these trends of consolidation to get better returns. Then that slows down and they have to disintermediate to get better returns. And now we're seeing disintermediation.
So from a U.S. economic perspective, some big numbers came out. The Fed's preferred inflation index, the PCE, or personal consumption expenditures, price came out, and it rose 0.3% in January, month over month, and 2.4% annually. So we saw that was a little bit above expectations. I think they called it a hot read from what the expectation was. So we'll see. It wasn't a huge jump, but it definitely was a little bit of a reacceleration there. The goods prices, overall goods, fell 0.2%. We saw the cost of energy drop 1.4%. That was one of the biggest. But we still continue to see a 0.5% rise in food prices. So still a little bit of volatility in those certain classes. The December PCE number was actually revised 0.1% lower. So it was revised 2.1% from 0.2%. So that's good to see. But overall, it'll be really interesting to see the February number when that comes out. And is this reacceleration trend continuing, or is it just kind of a blip? So we'll have to wait and see. U.S. retail sales numbers came out. They fell a seasonally adjusted 0.8% in January from December. So we're starting to see a little bit of weakness from the U.S. consumer. I mean, that's a first reading, and we did have a pretty strong December, but I think it's interesting to see. We do have consumer credit is at highs. There's a lot of things as far as the consumer being tapped out. So it'll be interesting to see, are we going to start to see a pullback in spending, which overall could kind of throw a wrench in this kind of soft landing we've talked about, because the consumer has been the main driver behind that. So it's a good thing to watch and keep an eye on is spending and consumer spending, especially keeping up. And then in the real estate market, home sales increased 3.1% in January from December. That's the highest level since August of last year. We saw kind of a slump in home sales as far as volume wise in the fall, and really the worst slump we've really seen in 30 years. So it's good to see those numbers pick up again. We have some more transactions occurring. In January, existing home sales, which make up the majority of the market, they fell 1.7% from a year earlier. So still year over year, we're seeing some declines, but we're seeing a little bit of a pickup from that slump in the fall, which is good to see. Did you have a note on there, Brian?
No, that's great. That's wonderful.
Turning to the international markets, European Union, the EU inflation rate slowed to 2.6% in February from 2.8%. So the EU seems to have a little bit more of a hold, if you will, on their inflation. They're not seeing the reacceleration we're seeing here. And what's that doing? That's kind of increasing the likelihood of us seeing a rate cut potentially in the EU later this year. So what that would do is we would see the euro, the currency usually devalue, and the dollar potentially strengthen based off of that versus the euro. So it's something to watch. Obviously, that does have an impact on global markets. Moving to China, so some of the preliminary new year numbers, the new Chinese year, came out, and so far they have not looked very good. China's factory activities index edged down to 49.1 from 49.2 in January. So anything below 50 is a contraction. So it continues and it's actually accelerated slightly. It's contraction. So um, not what you really want to see. And obviously, China's doing a lot. It's been one of the big things in the news as far as them trying to reinvigorate that market. Um, on the real estate front, China's new home prices fell 1.24% in January, which was an acceleration of a fall from 0.89% in December. So their real estate market, we've heard about their commercial real estate market issues there, defaults on debts, things like that, from property developers. But we continue to see home prices fall, and it seems to be accelerating. So that's not good news at all. Secondhand home prices, which is existing home sales in the U.S., but secondhand home prices in China fell by 4.4% prices. So it continues to be a very, very soft real estate market in China, which is overall kind of feeding into this weakened market. So a lot of issues there. Obviously China's aware of it. They are doing everything in their that they can to try to prop it up. And China does have due to their government structure, they do have a lot of levers they can pull. So, I wouldn't necessarily count them out as far as being able to, pump a lot of money into the market or extend very low interest loans, things like that to really pump up the market. But we'll see. And I think it's any of those instruments they use. I think you really have to take it with a grain of salt because yes, in the short term, we may see an increase, but long term, it still is overall hurting the foundation of that market. If you're
Yeah.
just propping the market up on fictitious government spending, things like that, it will eventually crumble. So,
Well, Chris,
and
let me
go
comment
for it.
on that. So now we're reporting negative numbers in China, and of course, China's avowed goal is to be the leader of the world and to eclipse America as the leading economy in the world. And they engage in all kinds of deception, like we talked about earlier, in massage parlors in the country. Their cars are seen as surveillance vehicles. So if they're giving us negative numbers, they must be negative, obviously, but they're probably a lot worse than we're hearing. There was a population number last year that came out where they said they lost 800,000 people in China, with over 1 billion people in China. But everyone believes that it could be anywhere from 5 to 10 times that number. So usually when the Chinese are actually reporting a bad number, it's much, much worse. And those are numbers we really can't trust because there's always a political end to what they're trying to do. But it's interesting they're reporting all negative numbers from China, and I bet it's a lot worse. So we'll see. We'll see what happens to China. They're in a world of hurt right now, and it's primarily caused by their system, their saber rattling, and their dishonesty with the world. So we'll watch and wait, see what happens, Chris.
Yeah. Yeah. I mean, and the impact that China plays primarily in the commodities market is immense. So, that's why we look at a lot of these numbers. They are a big buyer of oil, even industrial metals, things like that. So, they move markets. So if China looks like it's recovering, that will move some of these a lot of these commodity markets. So,
That's right.
they are closely tied. So that's why we keep a close eye on it.
Mhm.
Um, Moving to the commodities market, interesting news. So frackers, which mostly when you say kind of fracking, people think of oil, and that's what it was used for. But they're finding new ways or a new source of potential utilizing the technology to create or to leverage a new source of energy, geothermal. So if you guys aren't familiar, what fracking does is instead of just drilling a straight pipe down, and extracting the oil, they drill down and then they go horizontal, and then they kind of break the stone up and push water through the stone, and they're able to kind of flush out and extract the oil that way, which is highly profitable when you find ore veins instead of going directly straight down. Well, now what they're finding out is if they go a little bit deeper, they can actually leverage the heat from the earth down there to the geothermal heat to run that water through there, which then comes back up into a plant and can power a generator through steam. So then they can, once that steam condenses, they can kind of rerun it through the cycle and almost create an endless cycle there. So it'll be very interesting. Obviously, still the beginning parts, but there could be a new source of energy, from fracking
Mhm.
and a new profit center for them.
Mhm.
So that's a good thing to keep an eye on. Gold is beginning to run now again. We're seeing it moved above 2100 this week, so kind of the first week of March. That's based off of expectations that we're going to see rate cuts right now in the mid-summer, kind of June, July month. So we're starting to see gold move again upwards. Just as a reminder, when rate cuts happen, usually the dollar weakens, and when the dollars weaken, that's when we see gold kind of run at the
Mhm.
store of value there. So, and then the last thing from a commodities front, or I guess somewhat commodity, is Bitcoin. It actually hit a new record high today. So $69,007 per Bitcoin was hit today. So we continue to see it, and a lot of this is the momentum that was carried off of Bitcoin ETFs, things like that, that people were able to purchase. And I think we're just kind of seeing a momentum really move into that market. People, the next hope has been, I think, for like Ethereum and some of these other larger cryptocurrencies that we're going to see maybe other ETFs for them, in the near future. But what a major rise there for Bitcoin that was kind of stopped out at that $60,000 mark, and that really has moved up, broken above that in the recent weeks. So interesting to see.
Yeah. Well, Chris, last comments on the economy. Thanks for that update. GDP was revised lower for this fourth quarter from the first read of 3.3 to 3.2. So again, the trends are slowing. They may not slow all the way to recession, but they're certainly slowing. Rates are going to be higher than usual for a period of time, but there's still an expectation that rates will be lower this coming year. That's the positive scenario. Obviously, we did talk in the previous show on the negative scenario would be that the inflation comes back and rates go higher even from here. But the most likely scenario is the opposite, and we'll see which way it goes. The truth is, no one really knows. We're hoping to see positive things rather than negative things, all we can say. Recently, Chris, we also got an update from the top mortgage agent in America with Wintrust, Kelly Price. And Kelly shared with us some of the latest in home financing. Rates had spiked in 2022 and then 2023, and people are writing 7 and 8% mortgages when they previously had done 2 and 3% mortgages only a couple of years ago. So it really slowed down home sales. Um, and now with rates spiking, easing a little bit here, you have to look at what's the best product for you as an investor in a property or in a home, whatever it might be. And a lot depends on your credit score. But 30-year mortgage is kind of the fixed because it lowers your payment. But it may actually make more sense now, according to Kelly, to do a 15-year mortgage because as long as you're paying such high interest, maybe you add some principal payment and pay you down your house quicker. As long as you're paying high interest rates, you might want to consider that. So we're going to have Kelly on our podcast again soon. She's been a guest in the past, and we want to just get an update since the mortgage market is really so kind of crazy right now. But Kelly was ranked the number one mortgage agent in the Midwest for Wintrust. So we're very proud of her work on behalf of our clients at Four Star and others. Um, so now, Chris, let's move to what we see out there. There's some interesting things with companies, Boeing, JetBlue. What you got there?
Yep. So Boeing's been in the news as of late, obviously, mostly for their missteps or issues. They're actually looking now to take over Spirit Aerosystems. That's different from Spirit Airlines. So Spirit Aerosystems, which is a parts manufacturer that they purchased from. The reason for this is a lot of the quality issues link back to this parts manufacturer. So I think they're trying to solidify some of these quality woes, bring it in house, see if they can ramp that up. So we'll see if that fixes the issue. Obviously, they have a lot of things they need to fix on their end and really to gain the public trust and even I would say the regulators' trust before then. So be interesting to see, but they are looking to take over Spirit Aerosystems, the parts manufacturer. And then JetBlue and Spirit Airlines finally called off their $3.8 billion merger after the antitrust lawsuit. They couldn't overcome that. So, the anti-competitiveness of continuing to consolidate the airline markets kind of impeded that. So they finally called that off. And then the last thing I'll highlight, what we see out there, the Apple, as you alluded to in the beginning, Brian, iPhone sales came out recently this week, and their China iPhone sales fell 24% year over year. So Apple started to lose a lot of market share in the Chinese market. And who picked up that market share? Where did that market share go? Well, HTC came in and they saw unit sales rise 64% during that time period. So, really interesting. I mean, we've seen it from obviously an American perspective here, but this want to kind of bring things back to the mainland, if you will, semiconductor production, things like that. So we don't run into issues that we're in into 2020. We don't think about it as much, but other countries, I think, are trying to do a lot of that as well. Obviously, we've seen geopolitical tensions, as you talked about, Brian, security concerns, things like that. So, we're starting to see countries try to move, I think, and push leveraging products that are, built in country or are from companies owned in country instead of leveraging other countries' products. So it'll be interesting to see if this trend continues and as these geopolitical tensions either stay the same, hopefully they dissipate, but if they continue to rise, could this be a trend we continue to see into the future?
Yes, very interesting. The other comment about the China thing, obviously China getting too aggressive in the military and leadership world, trying to take over countries and take over leadership, has scared a lot of people. So a lot of people are leaving. China then is cracking down on Apple and moving their business to Huawei, Huawei technology, HTC as it's commonly known. And so now they're getting all the business in the phones and Apple's not doing as well. Apple stock has been down. Apple's slowing down. They're one of the Magnificent Seven that's not so magnificent anymore. So don't let that stock go down too far before you limit your risk from the upside. So also, Chris, you know what's going on out there? There was that trend where a lot of folks went on dating apps to meet people. Back in the 70s and the 80s and the 90s, before we had all these dating sites, people would go to, gatherings, sports gatherings, bars, other clubs. A lot of folks met in college and other places. But Bumble just recently stumbled. The dating apps are not doing well. The numbers were very weak. So now the trend is that singles are going back to bars and other places where they normally met. And now the recent survey is that 8 out of 10 college students want nothing to do with dating apps. So dating apps are losing out. Match.com, Bumble, Hinge. There's a few others. So that trend, we'll see if that continues. I see some value in dating apps because there's efficiency there, but there's obviously some parts of the dating process that are not handled very well by an app. People get ghosted and all kinds of different things that you can't really do in person. So we'll see. But Bumble stumbled. Let's just say it there. And then I also did mention the latest game in America is for many of the migrants to set up, different businesses. And the Chinese, particularly, are doing massage parlors, and they're spying on Americans, and they're reporting back to the Chinese government. So be careful out there, everybody, when you go into your next visit to a Chinese massage parlor. Okay, that's all. I'll just leave that one right there, Chris. Okay. And I think that's all we have today. I just wanted to remind everybody that we do regular blogging on very, very different and interesting subjects from different journals that we read, different universities, including my home university, University of Chicago. And we have one out there about the missing data influencing decisions. And, it's a little bit like people not understanding what data is and making decisions on it. So look at that on our website. You go into fourstarwealth.com and look for the microsites, the leadership matrix, and it's up there. And if you want to get your own copy of those blog posts when they come out, when you're on the site, it'll ask you to leave your email, and then you could get those blogging posts from us. And we send out I think a lot of very interesting things. So we have some more coming out. We're going to have a couple of interview episodes coming out too. We're going to have Kelly Price, the mortgage industry, on. So stay tuned for that. And we look forward to some future episodes. Chris, anything else?
No, I think that about covers it. Thanks, for listening and listening us to talk a little bit about the markets.
I agree. Thanks everybody for listening to another episode of the 4 Stars Today's Market Explained. a 4-star media series, podcast, video series. We're doing a lot of video clips now of just short commentaries that we're making on these podcasts when we talk about specific subjects. And so we're getting a lot of interest in those, and a lot of people are reacting to those and wanting to talk to 4-star about being an investor with us. So we're having a lot of fun with this, and we hope everybody enjoys it. Thanks for being with us, everybody. Chris, and why don't we sign off there?
Sounds good.
Okay, everybody, over and out. We'll be back again with another episode very shortly. Bye-bye for now.